where I share my 46 years of experience to help you manage your portfolios and protect your wealth. Remember to like and subscribe to these videos. Well, folks, it's been 78 days since I've been online, so we've got a lot to catch up on. Let's get into tonight's video. Well, folks, it's been a few days. I'm sure a lot of folks did not get the alert that I'm coming on, but at least you'll hopefully get notified if you're a subscriber. And it's going to be really important for you to subscribe and hit the notification bell. I'm not going to be fully back on doing the daily videos just yet. I'm still working on my new studio. This is the old studio that I was in before. So we'll stick with this for a little bit. There is going to be a number of things that I want to talk about. Is I am working on starting a podcast, which I have a lot of friends that are significant players of the past. So a bunch of us old dudes are going to tell folks about what we did. Some of these folks that I'm planning on bringing on the podcast is going to be a side channel to the Kendall Report. So lots of announcements coming up as well. So it's good to be back on, actually. And one of the things that I want to emphasize, like I said, I'm not going to be doing daily videos at the moment. A lot of content I'm going to do is going to be about education and moving things forward, mixed in with reports when there's things to go on. And right now, there's a lot going on, right? We've got the government shutdown, and I've got hopefully I get a bit of a rant for you folks tonight, because we haven't talked in so long, and the markets are, substantially higher from where they once were 78 days ago. So, but one of the things that we're possibly seeing here, we'll get right into the commentary, is that what we're seeing is maybe how ineffective and antiquated our system is that we've been living in for a long time. I've been in the markets, for a lot of years, 46 of them to be exact, and I've watched the evolution. And now what I think's being revealed, like Trump, hate him, whatever, what he has done is he has revealed everything. He's pulled the curtain back, and so look what's going on back here. And there's the corruption, the fraud, the cheating, all the stuff that's going on. And now we're seeing, look how well the markets are running without any government reports. We're going to see the Fed coming into the month. That's going to be one of the most, if we stay shut down in the government until then, that's going to be one of the most unique moments in time, because the Fed was already irrelevant. I've been talking about this for the better part of the year. They have no real need anymore at all. And, what if we could just focus on, wouldn't we actually know what the economy is doing through the earnings and through all the metrics that we see from the private sector? Maybe that's a better way to run this thing. It appears to me that all of the government reports, and I've talked about this, I've been going on this since we got that, actually for a while. I can go back almost 40 years ago talking about how the government reporting, and it's just a way to manipulate the markets, and more than anything, there's no real metrics. And it's just interesting how the financial media is no different than the mainstream media. They hype all the different elements. And if you watch CNBC, especially right now, you can see they're almost lost for words for what to say about anything. Especially, I think last week was pretty comical. I didn't watch a lot, but I did see some of the stuff going on. And, the realities are that we probably don't need that. We just need to operate, look at companies, how they're making money, and, and just if we could get rid of all the manipulation, maybe things would just be a lot better. Maybe blockchain, maybe Bitcoin is the answer. Maybe all of this stuff is kind of marching in a new era, as Trump calls it, the golden era. But it's really, there's a lot of changes. Excuse me one second. The studio has not been lit up, so I might have some background noises. But this whole idea that somehow we have to have all these metrics to run. I mean, like I said, markets are doing pretty good, and I'll go through the forecast, and it looks to me that things are going to move right along. It's interesting. For the most part, I've been on Twitter a little bit, writing the daily Substack, and we're kind of going to cover. I'll go through my rant here, but we'll cover some other items as we go through broadcast tonight. So since I haven't been on, it might be a little bouncing, a little random as we move around here. But the bottom line is, I think everything needs to be rebuilt. I've been around these markets, like I said, 46 years now, and everything looks broken to me. Everything, the healthcare system, the financial system, the banking system, everything is just completely broken. And it's just maybe not so broken, but maybe just outdated. I talked about the last time we and went on a couple rants in the Substack newsletter. And by the way, if you do want, it's kendallreport.substack.com. Sign up. There is an $80 annual offering that is, I think, $660 a month. So that's out there again. But make sure you get that, and we'll break down. Maybe I'll even bring down a couple of the things that I've been talking about there, so folks know that that's a good option to stay in touch with me and stay up with my work. One of the things that I think that with the broken system I'm talking about, it's really about the ability to recognize that that's the case, but who's going to do anything about it? I think Scott Bessent is really trying to change a lot of things in the I guess the configuration of how the government's running on the Treasury side, and that's pretty important as you would suspect. But we're likely to see if this thing goes the shutdown goes a bit further than where it is right now, you may see Trump go really rogue and really start to take out some significant things. This could be the opportunity to even break or fix the system. Sometimes when you're trying to change and you get too willy-nilly and start just closing things, you can break something. But it certainly looks to me that most of the systems that are run financial, whether it's the CME and the networks that we all use to stay up with all of the financial, we'll call it tick by tick, in the data side, these are all independent, and thank God the governments aren't involved in that. Imagine how it would run. So we're just seeing the exposure of everything right now. And it's going to be interesting because we're coming in not only to the golden era, but the era of AI, and a lot of efficiencies and things are going to start to come into play. So here's my goals for tonight, and I want to cover a couple other things before we move on. But the goal for tonight is, as soon as I get done, we're going to go through the database. I'm hoping that when I'm done talking here, the database will be updated so we can get into some ideas of what I think is going on the economy. Because if you folks recall, I went on for, 5-6 months talking about a Q3, Q4 slowdown that never happened. In fact, if you're reading Substack, that narrative has been shifting to neutral, and now it's just, a continued uptrend and a continuation pattern that has come out of here. And I'll cover that when I talk about the database. But the realities of what I think we're about to see is something fantastic, and I can't wait to write the annual report in December. I'll be writing the annual report and outlook for 2026, and I'll probably touch on 2027. And I still think it's worth a read. If you go back to what I wrote on 2025, you'll see some things that I was talking about then that have unfolded. And, so it's going to be very interesting. One thing that is fascinating to me, we're looking at 3 years of double-digit returns. I thought we were at that point where we'd run that cycle out mid-year and then start to see things roll over about right now where we are, and we're not seeing it. There's certainly elements that are out there. So I don't want to get too bouncing all over the board. So let's do this, and I'll go into the data, get into the charts, and that will kind of normalize and point us in a direction as we go on. But I would, once again, a couple things. I am finally, and I know I've been teasing you folks, but I haven't been online for 78 days, finally about to get the daily fact sheets, which I'll show. I've run the S&P for today, but I'm finally getting that service very close. We're in the final stages of getting it delivered. One of my big issues was with that whole project was protecting my intellectual property. And we have come up with a solution. And I think it's going to be amazing when you see it, because it's going to be a collaborative community effort that's going to generate a lot of the ideas that are going to be out there. So you're going to have, it's going to be fun. I think. I hope so. Anyway, that's my plan, because what these fact sheets that I put out every night are really interesting, especially when you have the ability to run them on your individual thing. So that's coming. I'm hoping by the end of the month, maybe within 10 days, we could have this project ready. There's a fair amount of work to be done for the delivery mechanism, more so than getting the technologies actually running. And we've been testing it, and it's pretty rock solid. So that to me is going to be exciting. And basically what I want to do, folks, after being off, I don't want to come back and do what I did before. I want to really be able to build more of a community effort and being interactive with ideas that are going to make us all money and all of that stuff. That's the idea of the podcast and bringing in more knowledge and things of that sort. I think we're going to come up with a pretty strong platform. I'm not sure what I almost gave out my secret name, so I'll leave it at that right now. But so let's go ahead. That's pretty much everything I wanted you to folks to be thinking about. Make sure you hit this notification bell and subscribe, because my broadcast for the next couple of weeks anyway are going to be somewhat sporadic. If there's some things going on, I'll come up and try to do some, do a stream that will help you to get through that moment. And I would also go to the Twitter account, because then I can hear your voice a little better. There's some other elements that I plan on bringing into the channel that will give us more interactive, more of a community type basis. And that's kind of where I want to go with this. Yeah, one of the things you never know in life is how long you get on the planet. So for right now, I have some things that I want to do to give back in a legacy, and a lot of thoughts and knowledge that I want to give out to the community and put it here on YouTube. So theoretically, we'll be there for a while. Maybe 20 years from now, somebody will see this old guy talking about some of the things that we're going to do. So I think we're good. Let's go ahead and before I bring you up over there, let me just see if the database has been run, and then that'll give me a good runway here. Yeah, it does look like it. Okay, let's go ahead and go over to the database. But the main thing that I want to bring in here from the standpoint of what I want to bring in here when we're looking at database, this is the weekly database. It's up to almost 69% bullish. And I want to tie together some of the things that I've been talking about, looking back in the rearview mirror, going back when the April decline was happening, and then we saw the V bottom in I really didn't think it was going to be like a 2020 V bottom, but it basically has been. It's just been a vertical move off of that low. But the a couple things that is interesting that breaks down with the reason why I was calling for several months, calling for the just come back up, calling for the the whole idea of a Q3 and 4 slowdown was the way that the database was trading early on. We were just slightly over 42%. If you've been around the channel, we have a database of 14,492 symbols. And when the traction gets above the 42% level, it tells you there's sustained, there's enough traction and enough of the symbols that are demonstrating trending type characteristics that typically the markets will stay stable and move gradually higher. When you get above 62, now we're at 69%. This is considered to be a full investment, and at that stage then there's a much more robust. I didn't see us getting above the 61 or 58%. Well, we did it, and it's been really in this tail end of this cycle as we came into August and September. This is where we seem to get the most of the traction from the standpoint of the database ticking up over 62%. So now we start to look at some of the forward. So a lot of folks say, I've heard this over the years because they don't understand. They're saying, well, the database lags. It actually doesn't. It has a forward looking. If you go back and you think about the things that I was saying, those of you long-term watching the channel back in 2024, because of the configuration database, I told you that 23 and 24 would be back-to-back double-digit returns, which we got. But this was all indicated through the database. Now this year, I thought we had a 52% compounded return basis the S&P 500. And I thought, well, this thing's going to go a little bit more, then we'll roll over and look like timing-wise we'd see Q3, 4. Well, as we went through the summer and grinding, this is, like I said, really in August and September, we started to see more traction come into the database, which pushed the forward-looking out further. And the way, when I talk about forward-looking on this, is what we're looking at is that the holding periods of the typical buy signal comes out of the system on the intermediate basis. We're looking at, right at maybe around 240 days, which those are trading days, which is a year in time. So right now, I'll bring you back onto the screen here. Right now, what we're looking at is if I come over here to the all stats page, you'll see that over here on a weekly, 207 is the optimized weekly. So a little bit under a year is a typical holding period. Right now, the current duration is 64. Duration fulfilled, we're at 31% of this cycle being fulfilled here. So it never gets to 100, by the way, here, but it does. We'll get into the 70, 75% level, and that's going to put us well into first quarter Q2 of 26. So just looking at from the database viewpoint, that's the case. And this is interesting because this is flashing back to the 2025, but so far, the utilities as a sector, okay, that's not as individual stocks, but as a sector is up almost 40%. And right now, that's been for 400 trading days. Typically, it holds for 261. And I talked about this in the 2025 outlook, because what's the most important thing on the planet right now is energy. It doesn't matter what it's made from. It could be coal, natural gas, but we need electricity. and as much as we can find. And I did see that there was even an executive order or something that was passed that they're going to allow, like Musk is building some giant electric factory in one of his big rooms that he's building, his big server rooms, just to power that room. And so that will, because the grid can't handle it. There's not even any way to move it around. Same thing is happening in Abilene, Texas. At that big thing, they're building their own power plant for that unit out there. And of course, they got natural gas coming out literally out of their ears down in Abilene. So, but you've got all kinds of fuel sources and everything that is possible. So we're looking at this utility sector. I don't know when this thing's going to let go. Typically, it's almost doubled its normal pattern. I do want to look at. Just want to bring something up here. Yeah, this is. I want to bring up the typical holding period. So we're going to go to the T button here. See if I can get this so you can see it. It's pretty tiny up here. Yeah, so we've exceeded everything. I just want to see what the longest. So it has been in the past 633 days. So right now we're still under that, but the returns, everything is blown. I mean, the typical standard deviation, one standard deviation is 21% return. We've doubled that. So that is, that's crazy what that is. So, and it should be that way based on what we're going with. So I'm going to wrap up just to give you an understanding that there is at least another 6 months in the market. There's likely to be some type of rotation that will occur, but there's still a lot of forward looking in this marketplace. People, the bubble talk is incredibly out there everywhere. It's a bubble no matter what it is, the AI bubble. And every week that goes by, AI is getting better. GPT-5 is somewhat of a disappointment. I'm pretty much a Claude user. But the bottom line is this AI thing is long from over. So it's going to take, let's see how long we've been streaming, 22 minutes. It's going to take a bit of time to get caught up. So I'll do a few of these meetings focused on long-term, trying to bring in some perspective. I'll try to get them into the more frequent over the next 2 weeks to try to get caught up, and as we come into the Fed meeting. So I'll do some meetings. Just don't count on every day. Hit the notification bell so you know I come live. Just do that. Subscribe. It'd be nice to see the subscriptions get over 50,000 finally. Maybe they're not shadow banning me like they were back in the day. So. But the database is very, very solid as we look forward. And, we're just, there's no way to deny what's going on in these markets. And to try to come in and present that somehow we're at the end of the cycle, it doesn't look like that. So we'll keep moving forward. Okay, so let's go next. Let's go over to the S&P. The daily still looks really strong. I mean, we got another maybe 3 to 5 days on the upside here, and that's probably likely to go from there. But what I want to focus on here is I'm going to start with a monthly chart because I want to bring in the longer term analysis. And then once we get through the monthly, I'm going to go to the quarterly cash markets on the S&P because it has the longest history that we can do some good work there and understanding the big, cyclical trend that's out there, which is always important to keep your eyeball on. And then when then we'll go, then from there we'll go monthly and weekly, and we're going to do that on S&P and NASDAQ. Depending on how long maybe I'll just keep going tonight since I haven't done one. We'll try to touch on some of the rotation that is trying to occur in the IWM or in the small caps. There's still a laggard. I mean, it barely just made a new high after all the S&P and the NASDAQ have been in new highs for months and leaving in the dust. Lately, there's been a little catch up. But let's go ahead. So let's switch over here, and I'm going to go to SPX instead of the futures. And so this is going to be a cash analysis, but I just want you to look at a couple of things here on the screen. Look at the forecast of the red dots that are coming up here. That's what I was talking about. This is actually stronger from the formation standpoint that we had when we were in the pandemic. Actually, this is a much steeper climb at the moment, and I think it comes out to a couple things. And just to back up from the macro standpoint, is that what we had is everybody, when we were at the April lows, the end of the world, Trump's ruined the country, we're going into a depression, and all that talk was out there, and the tariffs are going to cause inflation. None of that is going to be even close. It wasn't even close to right. The day that we printed the low, we had 11.5% range. I remember, I think it was a Fed day that happened, but it was a big range. It was a climactic move. I thought we'd go back to the 200, and it went back to the 200, which is where my cursor is, and then it just kept running. And now what we're seeing is one of these extended trends that are out there, and these things can literally, not quite forever, but they can go for a lot longer than you think. And you can see the forecast right now. This is still the daily forecast. I mean, this is just a 69 handle. I went back and looked at some of the things I said on that 78 days ago on that stream that I did. And I was talking about, and I mentioned this in Substack, you'll see in a minute, there's a 7,100 target on the S&P 500 that looks like, those of you who've been around know for a while, when I was on the trading floor, my nickname was Dr. Given, because I used to say it's a given. It's just go in there, buy it. And it was kind of an arrogant view of the world. And I'm telling you, this is one of those givens, and it's going to continue to climb. There's outside of something that sideswipes the markets that nobody seems to be aware of. This is the forecast, and this is a daily chart. So this is right now we're looking at, by the end of October, probably being at 7,000. And I was flashing back to the days in the pandemic when a lot of us first met, and I remember saying that the best inflation hedge on the planet is the S&P 500, and we were like 2,600 or something, if I recall. Go back. Matter of fact, I'll bring up that number in a minute here. And I said we could go to 5,000, 5,200. Here we are at almost 7,000. So the markets are pretty amazing, to say the least. So let's go ahead, and so this is the S&P cash that we're looking at, and we're going to go to we're going to just go straight to the quarterly chart. And I remember, and I'll give you the time here. Let me get a cursor on it. This was April 24. And there were three Fibonacci targets: 6,100, which seemed pretty lofty since we were trading at 5,400. And then the second target was 71.21. Now this is what I was telling you. You're going to hear this number a couple times as we go through the S&P. So we had 71.21 is this fib target. You can see the market grid numbers are already forecasting up at the extreme here. I'm just trying to get to the, yeah, market grids. Look at this. R2 for this quarter, for Q4 of 2025, is 71.15. So we have a, what's called the market grid is basically looking back on 3 bars and then projecting out Fibonacci targets as well as the normalized range that each quarter is happening. And so we can see there's been a big expansion in volatility basically since the April lows. And now we're looking at the R2 is 71.15. The Fibonacci target was, let me just bring that up real quick, 71.21. And then if we look at R3, 73.40, 75.41. So within the context of the fourth quarter, the volatility ranges, now these are different than Bollinger Bands. They're not standard deviation lines. They're true range lines, projected range lines. And the normalization says with the increase in volatility that we could see this quarter by year end 7,500. I don't think that's the case, but I think the Fib target 2 here is going to give us, let me just get that up again, is the 71.21. And then that also puts us at R2 on the range. So there's 2 targets. I love the clustered numbers when they come up. So 7,100 is probably the given. And that's most likely, guess what? You're going to have to see a continuation of the run with the techs. Everything that's been going has to continue or you can't get there from here. So don't get too bearish on NVIDIA and some of the big tech stocks. They're still going to, they have to be part of this. The way the index is stacked, we have to see those stocks participate at a reasonable level. They don't have to lead, but they have to participate. And then the back end or the segment just below we'll call it the Magnificent Eight. And just the next tier below that has to be fairly robust, and that's likely to happen. So I would say we could see 7,100 by year end. The downside volatility is, if you saw something that had maybe I'm just looking here at, you're not going to see it 6,500 handled. That would be the bargain of a lifetime. So, but this range is going to get very volatile. And then I want you to notice that around this is as we come in. So you have to remember this right here where I have my cursor is 2029. Okay, so that's 5 years from now. So the market's going to track above this 10-period moving average. And if I can, I'm just going to try to get you a number. These numbers are crazy when you look at these quarterly charts. We're looking at right now, it's 200, the 10-quarter moving average is about 220 handles per quarter. So that number's and by the time we get into end of Q1, Q2, that's going to be 600 higher, that's where major support will be. And let me just show you one more thing here. What we are seeing, I was talking about this in the last quarter, we're seeing some peak values from the standpoint of momentum, but this momentum is like insanely parabolic momentum. And so it looks like maybe after Q1 of 2026 that we could break the first derivative, and all that tells us is that we're going to test that 10-quarter moving average. So it's not even a disaster. It's a sideways, and there'll be some internal corrections that will happen from that standpoint. And what I mean by internal corrections, that there'll be a rotation in the what's being held. And whether or not, I'll try to get through all this because because I'm just looking here, I'm already 34 minutes in. So what I'll try to get to is to try to identify whether there's a real rotation coming in the small caps and the mid cap stocks to become the secondary stocks that are going to fill some of the gaps. Because all of these indices are very cap weighted, very, very heavy from that standpoint. So let's go ahead and let's back up a little bit now, coming down to earth, so to speak. We come back to the 1 month. Sorry about that. Hang on. So frustrating. Sorry. Okay. So as we get into the monthly, you start to see a little bit of a rollover coming forecast. Let me blow this up so you can see it. But and we look like at a flat period in 2026 all the way. So it looks like we're going to run up into Q1, Q2, and we'll flatten out. Maybe finally we'll get some of the momentum to roll over from that standpoint. But it's still the better part of 2 quarters from where we sit right now. So Q4 of 2025, then Q1 of 26, and then maybe some consolidation from there. And we're going to be way down the trail from that standpoint, and we'll have a much better situation. I'm sorry, I thought I had all my sounds off, so you have to bear with me a second here. Okay, so this whole scenario with the markets are going to really continue on. The question that has to be asked, and I don't have the answer for you tonight, but I will over the next week or so as I get back into the game, is what we want to see is if there's going to be rotation. What is the rotation? Is it the small caps, or is it just the secondary stocks that are in the S&P? And that would be more the mid caps. I know over the last couple of years, I've been more favorable towards the mid cap stocks than some of the larger or the really small stocks. I built a great portfolio in WaveTech that was a cherry-picked list of the stocks out of the Russell 2000. There's been a lot of money to be made if you're a stock picker in the last 2 years in the Russell. But as an index, it's just a dog. It gets up to its highs and falls back in. Indexing is, I used to always comment when all the ETFs and even the mutual fund back in the day was the mutual funds and ETFs were an effort on Wall Street to sell products they could make fees off of that looked like it was an easy game, or they tried to make it look easy. And a buddy of mine from the trading floor used to always say, it's never easy, and it isn't ever easy. It's not going to be easy. But the concept was the baskets of stocks, and a lot of investment advisors and people have used those, and everybody has, but primarily by the investment community has been big on the ETFs and try to stack these things up. But when you look at all of these ETFs, they're all structured the same. They're structured just like the S&P. They're typically cap weighted. Some of the managed ones might be overweighted based on something, but in the end, they just become just a basket of stocks. And an old buddy of mine actually one of my mentors, used to always say, the fastest way to mediocre gains and losses are using mutual funds. That's all he knew at the time, but it's the same with ETFs. You're not going to ever get rich on these things. You can make money, but the way that you create real alpha is through individual stocks and stock picking and having good strategies. And that I've spent my entire career, at least from around 1996, working on solving that issue. And a lot of it has been solved. And I'm working on the new evolution of that product as we speak. But the point is that a lot of the indexes do look like they're going to start to roll. That's probably because we'll see some cooling off of the AI, we'll call it bubble, whatever you want to call it, and that will flatten out the markets, and then that rotation is when we're going to figure things out. I don't think you're going to figure them out much before we get into rotation because they're hiding uh, all the stocks that you think are going to be the leaders won't be. We have to find that second tier, and that will be an effort that I'm going to be working on as we go forward. So one more level. I said we do a weekly. So let's go down one more level. We go down the next level to the weekly. You can see the weekly is starting to show what I've kind of walked you into it, where we still have a strong upward momentum as we go, strong momentum on the upside on a bigger secular basis. On the intermediate, there's still some upside. You can see the slope. I remember showing you folks gold, and it's followed this going back several months ago, maybe 6 months ago. But this is the same. Look at the trajectory of where it's going. Once again, if I just come out here to June, this is where my cursor is right now, is June of 26 forecast. Doesn't mean it's going to happen, but the forecast is saying that the 10 period moving average, or the 10-week moving average, is going to be around 7,300. So this goes to that 71 plus. Though, if you remember, I just went through it, looking at the numbers on the quarterly, coming back to the monthly, and those targets at 71, 73. This is where everything's pointing that that's where we're going. Everything's pointing that this is going to be sometime Q1, Q2 next year. So there's just going to be a lot of cash flow coming in. We're going to see a couple things tie in, some fundamentals, some macro things that are happening. We're going to see something like what we're a lot of these investments will start to flow in, and now we're going to talk a little bit about 26 before we move on. But you're going to see a lot of these offshore capital investments starting to come in 26 and going into 20, carrying out to 27. So there's just so much cash flow. When it's said that we're the hottest country on the planet, we really are. Everybody wants to be part of this, and there's just the capital investment, the reindustrialization of the U.S. is a real thing. And then especially when you start to see, and it's not just about all AI, there's a lot of other elements starting to come in and play. I think it's the Eli Lilly, they're building a facility. The 10-year investment is $50 billion. That's one investment by one company. And you can stack those up until they are trillions of dollars. So when you start to look at, let's pretend that the U.S. is a company. This makes Ray Dalio and all these guys talking about the debt cycle. That's such a waste of time. I mean, it's laughable, But the point is, with all the capital investments and things that are happening going forward, it'd have to be the only thing that would break this, some kind of major world war, and there's nuclear bombs flying all over the place, and nothing matters then. That's the only thing that breaks this cycle, I believe. Everybody wants to be part of the growth of the planet, and that's the bottom line. I mean, you could bring in Elon in the world, and I think he's right about Optimus. I can tell you that I'm going to have a robot the first day I can buy one. Okay, I want a robot in my house. I'm an older guy. Imagine not having to go to assisted living care if you could have 2 or 3 robots to take care of your house, take care of you medically. I believe that will be, as Elon says, the biggest product there is. And then I'm not going to go there, I'm going to touch on it, but there's demographic issues going forward. There's skilled people. These robots are going to fill an awful lot of skilled places that are really lacking right now. And they're going to be much more efficient. They're going to work until their battery gets low and there'll be a replacement. So there's going to be some things. I always call myself a futurist. I've been able to look out into the future a bit, and there's been a number of things in my past that I've called pretty well 15, 20-year trends out into the future. And this one's obvious. Everybody, this is me telling you what you should already know, is that these things that are happening right now are actually going to be the biggest cycle that we've ever seen. And it's just a matter of how it all plays out. And you can see demographics across the planet failing. China is going to lose 400 million people in the next 40 years. Japan has already lost like 1.5 million in the last 2 years. And that's not on a big scheme of things. It's not everybody, but you're seeing the same thing with the U.S., where, we're at a 1.7 rate of reproducing. That's why Elon's going, make babies. We need to be at 2.1 plus. Otherwise, we're all disappearing. And that's why I think these robots and everything's going to be huge. And I think as we come in between 26, 27, this is going to be a big impact on multiple levels throughout the economy. So that's why when we look at these long-term charts, they just keep going up and up. And that seems to make sense based on the type of efficiencies, the capital investments, all of those things that are happening right now. And as we go forward, I'll be breaking them out, especially when we start to see some of these cycles come into play and some of the confirmation that these are projections and thoughts it may be, compared to when we start to see incrementally some of these gaps being filled and going, there's a confirmation that is the trend and that's happening. So you have to, I've been telling you folks for years, have been following me, you have to be able to piece together the future as it's being confirmed and revealed. So you can look way out, you can look out 5 years, you can do a Kathy Woods analysis, but you can't confirm that until you incrementally see certain things that happen. You go, this is it. This is it. You can be Michael Saylor and have these fantastic dreams. Maybe they're right, but right now it's just all BS and talk. And I go to my dark road analogy. Trading is like having your bright lights on a moonless night on a country road. You're just watching for the next corner. You just don't want to drive off the cliff, right? So you're always looking forward as far as you can see, but you have to have these confirmations to validate these long-term trends. And you could say, hey, this guy said that 20 years ago. I've been in a case where I've said things 8, 10 years in advance. But during there, I saw the confirmations coming and the confidence that, okay, that was a good call. And listen, it's not about making good calls. It's about being able to position yourself and your portfolios. And I'll just put a side note in. This is part of one of the things that I'm going to be doing as we go forward. Start to build in elements and how you should be positioning parts of your portfolios as well, because we're in a process of redoing wave tech and building in some serious intelligence and probabilities and other things into the approach. Because right now, if you're using one of our products, it gives you good positions and it's based on the probability map of what it's done in the past. But now we can actually start walking things forward. It's going to be a big evolution of what we're able to do just through the through the math that's available to all of us right now, just through no matter what AI product you might like. I say AI is just like cars, right? I love Claude Code and Claude is one of my primary tools that I use. I use GPT for some, but those are the things that because of the projects that I'm working on, I have time to focus on and use. So all of these trends are real and they are going to continue. And all the forecasts, everything that I've went through continue to confirm that this is where we're going. So I spend a lot of time. I know I'm at 15 minutes in. So here's what we'll do. I'm going to walk through the NASDAQ very quickly. We'll touch on the Russell. And we'll look at interest rates, and then we'll probably close out with Bitcoin. And I'll see if I can't get up at least one more time this week on the channel, and we can kind of continue these talks. So do me a couple favors is make comments on the replay. They're easier to come back and see, and also for the community to see as well. So make your significant comments that you have about anything I said, you don't like, you disagree, whatever it is. Put those on the replay, and that will be easier for me to respond to, and I want to see them and see what kind of reactions you folks are having, especially since I've been offline for 78 days. So we'll go from there. So let's go ahead to the NASDAQ and dig in. Sorry, I haven't been able to look at any of the comments. I want to stay focused at the moment. When I get done, if you're willing to hang around, probably going to take me another 20 minutes to get through the rest of this. We'll see here. And as you would expect, this is the weekly NASDAQ, same trajectory. We look at one of the things that's happening. It looks like this is something I have not talked about for a while. I haven't brought up my drawing key, but this is a very significant. Those of you who've been around since the pandemic, back in those days when I used to do the 3-hour live streams and talk about some of these trends. But let me draw something in here real quick, and you'll see what I'm talking about. So this is something, and this is also for those of you that have the PPMs. This is a big lesson for PPMs, is this pattern right here. I'm going to draw it in. This is probably the most relevant one we have out here. And then I'm just going to draw this under. So this is PPM1, which is tracking, this is a weekly, the 10-week moving average on the NASDAQ. But this is what I talk about. This is the boost. It's like, think of a half pipe where you take a ball, you got a half pipe, you take the ball up on one side and you drop it and it swings the momentum, and it takes a while till it burns off, right? Each slide, I think it's around 60%, and then the percent of the retracement gets less and less until it flattens out if you just let it go. But what happens in markets is sort of like it gets reset. You get a surge in market. It's like putting the ball up the top, and then they see momentum. It's still strong. Then it dissipates, and it gets reset. So when you look at the PPMs, this is a way to look at this. This is the ball being pushed up all the way up to the outer edge. And then what happens is it corrects, but it's still a highly positive number. For instance, right now it's 0.94, which is 4 times the minimum number for an uptrend. So the fact that it's coming down, it's still in a very strong uptrend. But this is the key, is all of this where we see these indicators flattening out, it looks like momentum's being lost. What's happening, that is what we call the trend maintenance mode. So this chart is so strong that we have, looking out all the way into July of next year, just a trend maintenance. Now, what can happen between, let's say, the next 8 months is all it takes is for maybe another surge in the markets, maybe there's something happens, and then this thing gets reset again. It goes back into maintenance mode. So you're just seeing in a different mode of that ball swinging back and forth in that half pipe. So this is like totally crazy bullish, looking out at least the better part of a year. And you can see the forecast, and this exists on the S&P that we just looked at, and I will bring IWM up. This is probably as far as I'll go for right now on this NASDAQ, but just to give you a sense that this trend is going to continue. And like I said, with the lack of, we'll say, better ideas right now, the AI tech level, that's what this index is anyway, but it's being driven in the S&P as well. These trends are going to continue for a while. They're not going to collapse. And the more talk you hear about a bubble in AI, the less likelihood that it actually is. Uh, any of the bubbles, any of the surprises, black swans, all that stuff, they're not available to be seen. They hide behind the scenes and they show up one day, like the '87 crash. But I'd have to say that's one I called because I wrote a newsletter on September 16th of 1987 that I said the risk reward to owning stocks in the U.S. is zero. Get out. I wasn't predicting a crash, but it was just all used up. Everything that was there, all of the. I've been using these PPM since 1984, so this was like 3 years into my own learning and understanding of these indicators. So, but when you see this mode, this could be on a 5-minute chart, by the way. It doesn't matter when these type of events happen. That gives you that continuation pattern. All right. Let's go to IWM. We'll use the. So I want you to notice something, and this is a total different pattern. And this is my argument, Tom Lee can say whatever he wants to say. If you notice, notice how bullish he is on Bitcoin right now. He just got a big Bitcoin deal, right? Why wouldn't you be? These guys are always talking their book. We all do. But if we look at going back to the Russell here, Russell is flatlining. It has some of those continuation, but you can see it doesn't look at all. Let me go back to NASDAQ for just a second here. NASDAQ almost probably about a 35% grade or angle of attack to the upside. If we go back to, we'll just stick with IWM. If we go back to here, you see complete flattening. And my argument has been, we're going to go and do the 10-year next. The argument has been that there's no way that these small cap stocks are going to get any real momentum to the upside until we get the yield curve to be completely different shaped. I'm going to do the treasuries. I'll show you what that means in a minute. But you have to there are a lot of regional and small banks in this index. This is the worst index in the world if you look at the breakdown of the companies and the demands that the companies have on money and the structure of the yield curve. These things have been, this group has been lagging for not a few years, but for like a couple of decades almost. So there's a reason for it, and it's been the structuring of what the Fed's been doing for a long time. Another reason to get rid of the Fed and get rates maybe more balanced like they should be. But the bottom line is this is flattening out. There's not a lot of momentum. In fact, some of these, and when we were looking at the NASDAQ forecasts, these are, we'll just call them fictitious numbers, but based on the algorithm that's running the dots, which are the forecasts, they're saying that these numbers are going to go negative, which means that the Russell would be in a downtrend where everything else was projecting new highs and a continued growth pattern. So these are not the growth stocks. These are not the alternative based on analysis that I just showed you. There's still more the same. And one of my old mentors used to say, expect more of the same until they show you something different. And they haven't shown us anything different. In fact, all the capital investments and everything I talked about a few minutes ago is exactly more the same. And we've got, there's capital investments stacked up for the next 10 years in these other areas. So it's just going to be difficult for this index to do anything significant. Not that you couldn't have made money buying it. I'm not saying that. I'm saying that on a relative basis, this is still another dog with fleas, and it's going to stay that way for a while. All right, so let's go to the 10-year. This was if you were reading my Substack during the last Fed meeting. What I was talking about was that even if the Fed drops rates, which they did, you'd see a little bounce. We went down to 3.99 on the 10-year. That was the low. And then it bounced right back to 4.25. And that's what I said it would do. The long end of the curve is going to stay around this 4%. Real estate is going to have its issues for a while. Lending standards will change if the front end of the curve gets down. Let's say the Fed funds 1-year note get down to 1-year T-bill will get down to 3%, maybe 3.25%, and we have 4.25% in the back end. That will not necessarily change the cost of money, but it will change how money is being lent out from because you can borrow short and lend long. Right now they can't. We're looking at straight flat line. Okay. Let me see if my memory works here and see if I can get. See if I can get to this one website here. I believe this is it. Yeah. Perfect. So you can see we got four. The 20-year is over here. If we come over here to the 10, basically we could draw a line straight across here. In fact, let me do that. Let's just talk yield curve for a minute here. I hate all these ads they put on this. I guess if I paid them, they wouldn't put the ads up for me. They're being annoying on purpose. All right. So this is basically right here is 4%, and the 10-year is just slightly above. So we have a slight steepener by maybe, if you came down here, that's the 4.25, but here's the 4%. So you got a little bit of a steepener. What we need, you can't even, we need, let me just change colors. You can see this is what we need, minimum. We need the yield curve to be around 3.25, and 4.25 on the upside. That's a 1%. We need 0.75 premium to 1.25. At that level, if we had, so I would say Trump isn't wrong about this. If we had a 2.75 yield in the front, initially I think you'd see a bit of a dip in the 10-year, but it's going to seek this 4.25. The absolute, if that happened, we're not there, we're at 4%. But if we're at 2.75 to 3.25, then this yield curve would actually be very meaningful to a lot of areas of the economy and give the ability to actually be able to get certain elements of the economy to start to go and certain elements of the stock market to start to play as well. All right, so let's go ahead and go back to the so I'm going to we're going to talk Bitcoin here, and so we printed another high. We're up $1,400 again, but this is basically that trend maintenance mode where we get this ramp up and then we go flat. All of these have done this, and a lot of times the 200 will tell you a little bit more about the expansion of the trend than these others. So I'll leave that alone for right now. I am going to do some breakdowns. I'm going to do some videos on the PPMs. I'm going to do some videos on understanding internals of the trend and how to play the trend. I'm going to be doing all this stuff. I want to do that. As somebody once said, Bob, teach us how to fish, don't fish for us. So that's kind of where I want to go with the channel. I'll still do interactive sessions like this that we're doing right now as we go forward. But this is the other thing. Look at the going back to May of this year. The targets were 134.215 on 157.40 and 171. That's these Fibonacci targets. This makes Tom Lee look pretty smart if that happens. But right now, what we're seeing, we are in trend maintenance, and the trends are trying to flatten out. Let me broaden this out a little bit here, so you can see what this looks like. So we got an RTX sell signal. This is a weekly chart, by the way, and so we can see we're probably going to flatten out and do another consolidation. And this has been how this market has traded for a while. Get a boost up, new high, consolidation, new high, stair stepping up. This is probably a running ABC wave 2 here. So if we go into 3, we will see 200,000 easily, 2.25. But right now, like I said, if we look at the target range here, this is where the targets, and that's been the target since last May, and we just continued. The only thing I would say is that the forecasts right now are flattening out, which is still within the pattern: new high, consolidation, new high, consolidation. So not a lot more on that. One thing that is interesting, everybody that has significant interest in crypto is out there with their megaphones just screaming, buy now, you're going to miss it. It's interesting because I made a comment on a Twitter post to somebody, is if they're all hodling anyway, why do they care? I mean, they're not going to sell. Michael Saylor telling you they're not going to sell, then he sold. Then he's yelling buy again. So, whatever, but you got to pay attention. This is a market when I will admit that other than the technicals that I look at, I don't know a lot about what's going on fundamentally, or what all the different things that crypto folks talk about. That's not my world, but the technical part is my world. So that's kind of where I get in there. So I don't know a lot of the stuff that's going on. This is what are there 40,000 crypto coins, something like that now. So dwarfs how many stocks are in the market by a long shot. So there's probably, if there weren't the 40,000 shit coins out there, you'd probably be at 200,000 right now. It's got to dilute the pool of capital, right? So we'll see where it all goes. All right, let's do this. Let me look at see what some of you are talking about here just for a second. Yeah, I see. Yeah, I saw that App Lovin got creamed. We'll see if they have any real SEC problems. Good to see everybody again. Shaitan, Pamela, all the old folks here. Yeah, that's true. On the NDX trend, it's so strong, there's no upside targets. The reason for it is you have to have some kind of pullback and form some formation. It just keeps going up. And the data sheets keep freaking out that there's the way that I've trained them to think that, you need to have some upside targets. And that's something I'm looking into, not as a problem with the sheets, but there are upside targets, but they're not the big Fibonacci targets like we were looking at here on Bitcoin. Let me just look at a few more things here, folks. Yeah, I was looking at uh, Ether as well. Somebody said to look at it. Like I said, it gets pretty. There's so much going on out there. Yeah, if we see 75 to 8,000, I'll be with you. I'll be selling there. But there's so much more money beyond these indexes. Yeah, I don't know. I didn't look at that Earth Cruiser. He's asking why were brokerage companies like E-Trade, Webull, Robinhood, Fidelity all down this morning? I don't have an answer for you, but I will look into that, see if there's anything there. So make sure you get the a couple things I need to talk to you about if you're hanging out. Still got 170 folks hanging. Two things is get the Substack. It's $8 a month, or get a year for I think $6.50 per month if you pay the $80. Get that. And if you haven't got the indicators, go to kindlereport.com/indicators, and it might be indicators 24 if that doesn't come up right. But get those, because I'm going to be releasing not the TSX file, but the ability for you to get the data into this module that we built that will be in a membership site. And I will do a complete video when I have this thing done, because this is going to be, I think, one of the coolest projects I've ever done, because I'm going to do it basically built off of a community basis, and I'll explain that later. But if you haven't get that, if you own the indicators, then you will get a discount on the membership. Everybody that's bought the indicators before will get the discount. There's thousands of you that you're available to get that, and then we'll the new folks, there will be a bundle as well. So make sure that you get those, and the bundle price will be basically the same for everybody. So I'm not going to not give everybody the same price. And once again, that's Morgan's. Yeah, listen, anything Morgan, you're looking at a former analyst at Merrill Lynch. Okay, I've been in the big research rooms, and it's called marketing. It's not actually research. But yeah, so if Goldman's saying that, I mean, just fade all these guys. It's pretty simple. Yeah, just looking through some comments here, folks. So just bear with me, and then we'll call it quits here. Where are we? Not too bad. 114. Yeah, I don't know. Yet I found this, as somebody, Calga says, sideswipe and cyber attack on financial system next few months. Maybe. Trying to predict a catastrophic event is not much you can do about it. You think about all these guys that you see, including Ray Dalio. I think he's kind of relocated a little bit down in Singapore, if I heard right. But if any of these guys believe what they said on all this stuff, I mean, if you have any money in the markets in that, then if that you believe that, you should be in your bunker. It's tough. Trying to call something like that, and it's certainly possible. That's one of the vulnerabilities of the planet. That's for sure. It's not. I'm just saying there's no purpose in spending your time unless you're really doing something about it. And if that were the case, you'd be underground and not on the internet. But just looking at a couple more comments, and then I'll close out here. Thanks for all the welcome backs. It's good to be around, good to be seen, as they say. What? Let me just look through another minute, then I'll just come up and summarize stuff. Yeah, I think the reason why gold's been doing real well, somebody made a comment about it's been exploding, is because all the Bitcoin guys are telling you how much better Bitcoin is than gold. So it's been a great trade. I will have to say. Uh, the algorithms we didn't do gold today, but like I said, I'll try to get up one more time this week. We'll see how the week unfolds, and I'll do my best to get back up here. It felt good to talk to myself for an hour, so that was good. Yeah, so let's just close things down. So just kind of summarizing what is happening here is these mega trends that are out there are not going away anytime soon. Chances are, when you see my outlook for 2026 and beyond, it's going to be pretty bullish just because of the capital investments, the things that are going on the planet. I would suspect that all wars will be at least temporary over if humans could just spend their time doing more productive things and what we see here instead of trying to steal land back or whatever. We could have a more peaceful time, which in itself would be bullish. You might even look at just looking at the history of the stock market going back, 150 years, and you're just looking at, really man coming into his own right now. I think the AI, the robotics, all the things that are in front of us, intelligence, whether it's getting chips implanted in your brain or whatever, whatever it is, there's a lot going forward, and there's a chance that there's going to be fewer humans participating. So if you do the supply and demand, there's going to be more money to go to fewer people. So the whole idea that somehow distribution of money and all that is going to happen, probably not the case. I don't think it works that way. It never has. There's no reason for it to work that way. And there's no system that I'm aware of that's going to work that way, not socialism or communism. Those have been failed projects for a long time. Watching the New York situation is going to be, that's going to be fun, I think. Every so often you have to have something happen to remind people what a bad idea socialism really is, especially the democratic socialism, which is China, by the way. And it's kind of hard to argue that they're not successful. But I saw a bit of that coming because I spent in 2003. I spent a month in China, and that was I saw that if they ever got that place digitized, that it would explode in it, and it has. So it's going to be interesting. Demographics are against. China's at its peak right now, so everything's downhill from here on from demographics, and that's why the robotics and all those things are important. Anyway, folks, great to be back. Hour and 15 minutes, 18 minutes. Yeah, hour and 20, we'll call it. It's been great hanging out. So like I said, I'll try to get up again this week, and for sure I'll try to get up at least once a week. When the new studio's done, then I'll be starting to roll out some of these other ideas, new podcasts, educational videos. I'll be doing some videos on this new platform that we're about to launch, which I think is going to be super exciting. When you see how the functionality is going to work, I hope you folks see the idea as cool as I've been wanting to really build a community of some sort that really interactive. And I think this will be it. It will be the beginnings of the evolution of what I want it to be, but it will be that. Anyway, thanks again for watching. Have a great rest of your evening, what's left from where you are, and I will talk to you very soon. Make sure you hit the subscribe and the bell so you know I come live. Thanks a lot, everyone.